Coming up in today's video, volatility jumps. VIX is up 7.6% at the time of recording. And gold is moving lower here today. What's that all about? The dollar index is also on the rise, and oil prices dropped hard here today, down 1.5%. Now just take a look at natural gas, down 6.7%. Bitcoin reverses its gains from over the weekend, and the 10-year yield continues to climb despite expectations for a Fed rate cut this upcoming Wednesday. Meanwhile, with stocks just about at their all-time highs once more, this is a huge week in markets, as the Fed will likely cut interest rates, but it is more about what they signal next that really could shake up things to the downside or upside. Let's talk about which way I think it will go and why. As we get started, just a reminder, none of this is financial advice. I'm just sharing my thoughts and opinions. The full disclaimer can be found below. I'll be going over some of the ideas that I am seeing in markets at this time, as well as some of my current positions that I have on. If you could hit the thumbs up button and subscribe, I would greatly appreciate it. Let's jump in. So starting things out here on the S&P 500 daily time frame chart, you can see that we are pretty close to a new fresh all-time high. And with a Fed meeting just 2 days away, the question now is pretty much answered whether or not we're going to get interest rate cuts on Wednesday. The answer is we are very likely to get a rate cut. The bigger question is not whether or not we cut rates this week, but rather what forward projections for future interest rate cuts are looking like. Remember that the market is always forward-looking. By the time an interest rate cut decision has come to the forefront, it was already well determined by the market, usually weeks in advance. In this case, the market has already been pricing in and fully expects a rate cut on Wednesday, with a small chance of a surprise from the Fed. The bigger question is when we look out to January of next year, are we going to get another rate cut or not? And what we can see here is probabilities are that we are going to see a rate cut this week, and then we're going to go on pause for some time, and then potentially the next cut is expected in June of next year. But of course, these things change all the time, and just because probabilities are something today does not mean they are certainties by any means. They are probabilities according to the bond market. So what could change this outlook? Well, it is largely about the jobs market and inflation. Here's a look at US inflation here recently, which has been back on the rise, but still much better than where it was a few years ago. Remember, at one point we were around 9% inflation in the US. It's now at 3%. Now, 3% inflation is still above the Fed's target inflation rate of 2%. And so one might say, well, why would the Fed cut interest rates if the inflation is already high? If you cut interest rates and spend more money into the system, doesn't that cause inflation to go up further? Well, it can, but there's also another problem that the Fed has on its table. Job openings here in the United States have been in decline for multiple years. And when we look at the NFP report, although we recently had a better than expected number be printed here in November of last month, of course, let me say that again. And while the latest reported NFP report came in much better than expected, it's still generally a pretty weak jobs market in terms of people being hired. Now, I should clarify that the jobs market is sort of tired, but it's not necessarily collapsing. If it were really collapsing, this thing would be in the negative territory, meaning mass layoffs are actually happening and surpassing any sort of hiring activity. We are in a low hiring activity market. We're not in a cratering jobs market. Here's a look at ADP, which focuses on private payroll numbers. So ADP's reported figures for private payrolls have also been in decline. And so it's fair to say that the jobs market is definitely showing signs of cooling. And the Fed is probably saying, okay, we need to stimulate the jobs market a little bit before this thing goes negative. Because if the jobs market goes negative, it comes with a lot of pain and it could lead us into a nasty recession. So it is largely expected that the Federal Reserve will cut interest rates or continue to cut interest rates going into this meeting this week and going into 2026. And there's an old expression on Wall Street, which is don't fight the Fed, aka when the Fed is easing or cutting interest rates, it generally is a tough environment to bet against stocks and gold and things because, again, that is straight up money getting injected into the system. Whereas the mantra, don't fight the Fed, when the Fed is hiking interest rates means be very careful trying to go long stocks because the Fed is sort of contracting the existing money supply. So when it comes to interest rates being lowered, I generally see that still as a bullish tailwind in the US stock market world. Personally, I'm still long the NASDAQ, which I bought a few weeks ago actually, and held through this really nice November and December rally that we've seen so far. From a technical perspective, we seem to be finding some resistance, at least for now, around this current level. What I'd be curious to see is if we can actually get above this area and retest it. Any sort of retest to me would be, or any sort of breakout, I should say, would be a point where I could take this stop loss that I have trailed and move it further into profit. I have my eye on a return back to the all-time high, and I think that is very likely what we are going to see going into end of year. However, I don't know that for certain, and I do as little predicting in my trading as possible. I follow trends, both macro and price action-wise. From a price action perspective, taking a look at a simple collection of moving averages on the daily time frame, we are still in a dominant overall upward trend. I will only get bearish if this truly flips into a downward direction. Until then, I actually think it is more difficult to try and time where this trend is going to end than to simply be a dip buyer, buying pullbacks, and constructively following price with a stop loss. That is how I have personally traded the markets the last, 10 years or so that I've been doing this, in the last 5 years really, where I became, heavily involved in macro fundamentals and trend following. I think following trends is two-parted. One, it's looking at technical price action, which I think anyone can do with a collection of moving averages. Number two is actually following the macro story, which can be really complicated at first, but with the right tools can actually be really simplified. If I take a look at my economic heat maps here and I go to US economic heat map, what we can see here is it populates a list of really important economic data that the Federal Reserve is using to make their decision as to whether or not they want to cut, hold, or hike interest rates, which is ultimately the money printer that injects or pulls away money from the system. When we take a look at some of our recent metrics here, what we can see is we're getting a pretty solid overall reading for US stocks. Things like the non-farm payroll look better than expected, while ADP was soft. When we look at jobless claims last week, that was really solid for stocks because we had a really nice overall outperformance in terms of unemployment claims came in very low, meaning less people filed for unemployment. That's a good thing for stocks. Why is that a good thing for stocks? Well, if people are employed and they have money coming in, they're more likely to go out and spend money, which is stimulative to the corporate earnings of America. Remember that if you're someone who trades stocks and indices, it's all about, in the long run, corporate earnings. Are they strengthening or weakening? That is a macro trend that we can look at through economic data. So GDP growth coming in better than expected supports strong earnings for US stocks. If the labor market improves, that also supports strong earnings for stocks, as people who are employed are much more able to go out and spend money and buy a home or buy a car, etc. And real quick, if you're looking for a free way to learn fundamental analysis, I have a challenge for my viewers here today. Inside of our Telegram channel, we are sharing daily macro fundamental breakdowns on currency pairs, commodities, indices, etc. I challenge you to spend 10 minutes a day coming into the Telegram channel and reading along for free for the research that we've been putting out here in the last few months. Is a free way to learn. And actually, I think I'm a big fan of, if you're going to learn something or improve at something, do a little bit every day rather than try and do it all at once. So if you join our Telegram channel using the link in the description down below, you can read along each day and learn something more about fundamentals. And I promise you, if you do this for 30 days straight, you will improve dramatically in terms of understanding the macro. This is the stuff that moves markets, and most people are too afraid to learn it because it is a bit daunting at first. But with the right free educational resources or software tools to track this stuff, it can be made easy. So like I said, I'll leave the link in the description down below. And if it's easier for you and you're watching on a TV or something, simply scan the QR code that you see on your screen right now to be redirected to the Telegram channel for free. In other news, I thought this was kind of interesting. The ECB, which is the European Central Bank's Schnabel? Scanable, I don't know, comfortable with the bets that next move will be a rate hike. Kind of interesting because the ECB has been on a rate cutting sprint here recently. As we can see here under the interest rates historical tab here on Edgefinder, you can see they've cut interest rates pretty dramatically from where they were, 4.5%, down to where they are now. But it's interesting to kind of see that they seem to be more at the end of their rate cutting process. And I think this makes sense from a really simple real yield heat map perspective. Check this out. So when we look at Europe specifically, what we can see here is that interest rates around 2.15% are about on pace with their inflation rate. And typically this is what you're going to see from central banks is they hover around their interest rate, around their inflation rate to sort of kind of stay competitive with that in terms of real yield. But I thought that was kind of interesting. So their idea that the next move is likely a rate hike would be that they potentially see some growth and possible inflation coming in. So might be an interesting thing to watch for. And the Edge Finder seems to be on the same page with this. When we look at the Euro US dollar very bullish reading, you can see we're getting a +10 score with sentiment, technicals, and economic data suggesting we could see some strength for the euro. Taking a closer look at this reading from Edge Finder, you can see why we're getting a very bullish reading by navigating to the AI market scanner page. Technicals look straight up bullish here recently. More on that in just a second. Our economic growth signal has shown some recent higher than expected readings for Europe. Jobs market's a bit neutral, and inflation reading actually looks kind of interesting here, favoring Europe for now. The crowd also seems to be very bearish on the euro. Let's take a look at that. If I navigate under market sentiment, retail sentiment, and then go to, let's just do major currencies, take a look at this. Crowd sentiment seems to be very heavily weighted towards being bearish the euro US dollar. This is producing a contrarian bullish reading within Edge Finder. Here's a look at the daily time frame for the euro US dollar, and something interesting is sort of happening here. You've got a major level of resistance back and being retested once more. I think if you can actually get a break through the highs here, this actually looks like it may have some upside potential for a euro dollar breakout to the upside. So I do lean bullish on this pair, but would need to see a break of resistance for a possible breakout move. From a technical perspective, we do seem to have gone from a downward trend to a sideways one. And I really would like to see this thing break out just to sort of confirm a higher high is in the making. But with euro dollar getting a very bullish reading, this one looks really attractive for possible buys for me. Let's also take a look at the Kiwi dollar and the Australian dollar as well. The New Zealand dollar looks really good here, breaking this downward structure. And if we were to get a little bit of a pullback here, this one actually looks strong for a possible long side continuation. And the Australian dollar is actually breaking through this level of resistance here, at least for now. We had a nice solid close and now pulling back into this area. Could be looking for some further upside, maybe a push back up to this 66.80 prior high. Today's video is sponsored by Black Bull Markets. Black Bull is a New Zealand FMA regulated broker offering forex, metals, and crypto trading to their users. With access to over 26,000 tradable instruments, everything from gold, commodities, indices, and more, through their CFD platform, you can trade pretty much anything. They're also backed by one of New Zealand's largest investment management firms and provide institutional grade trading conditions. Black Bull Markets has also earned multiple industry awards for their fast execution speeds and their leverage trading opportunities on their platforms. Traders can access up to 1 to 500 leverage and choose from several platforms like MT4, MT5, CTrader, and TradingView. And something super cool is that they offer no commission on crypto trading, as well as highly competitive spreads, especially on Ethereum. And for a limited time, active traders can receive free TradingView Premium and up to $60 reimbursed every month just for trading with Black Bull. And if you're interested in copy trading, they have an expansive platform just for that. You can see real trading results from other traders in a live environment through their copy trading platform. And when it comes to choosing a great brokerage, choosing one with competitive trading costs in the form of spreads and commissions is very, very important. With their ECN Prime option, you can see spreads from 0.1 pips, which is pretty crazy. And of course, if you're a larger trader, this institutional package looks incredibly competitive, with spreads from 0 pips as well as a $4 round turn commission. Of course, there is a minimum deposit on this, but all three of these look highly competitive compared to the industry. Make sure to use the link in the description down below. We'll leave all the information you need to start trading with Black Bull and start taking your trading to the next level with their amazing platform, their competitive spreads, as well as their copy trading platform if that's something that you're interested in as well. So like I said, make sure to use the link in the description down below to support my channel and also to check out Black Bull to see if it's a right fit for you. Now back to the video. I also wanted to talk about Bitcoin, which is potentially setting up for a trade for me this week. We've been talking about on the channel that Bitcoin has really had some struggle here this year, breaking some of the seasonal patterns that we've talked about quite a few times. So what you're looking at is the full year seasonality for Bitcoin. The dotted line is where, historically speaking, Bitcoin tends to move during different months of the year, as you can see across the bottom of the screen. So November, December, and October are typically a very good window for Bitcoin, but this year, Bitcoin seems to not be cooperating at all. I make this point, and I've been showing this quite frequently, because a lot of people have a very big misunderstanding of how financial markets and analysis in general works. Analysis is like having, good analysis. Somebody who has great trading statistics may have like a 60% win rate. But what that means is that a 40% of the time, that same person is just going to be straight up wrong and take a loss. So something like seasonality, which is an observable thing in markets and a very powerful force, can also still be wrong sometimes. In fact, most traders are looking for something like a 90% win rate that just simply doesn't exist. Whereas great traders recognize that if you can just do 60%, I mean, if you do a 60%, you're doing phenomenal. If you're doing 52%, you can make money in the markets, right? On a one-to-one basis, 52% of the time you're right. Over enough re-entries and iterations, you can make great money. Where most people go wrong is they're chasing something that simply doesn't exist and wondering why their results are terrible and they keep blowing accounts, is because they have unrealistic expectations for financial markets. Seasonality is a tool, but we use many tools in our analysis, and that's what I'm hoping that when you watch my videos, you recognize this is stacking evidence, stacking probabilities, stacking confluence tools. No, none of this is certainty, right? It is all about educated guesswork, and we manage risk with small enough position sizes so that when we're wrong, it doesn't sting too bad and we can get up and try again. So sure, seasonality didn't really hold up very well for seasonality so far this year. Could we have a little bit of a late stage rebound for Bitcoin? Maybe a late Santa Claus rally? It's possible. From a technical perspective, I'll show you what I'm looking for. I would love to see Bitcoin break back above this 92,000 level of resistance. Well, I guess that's more like 94. But if you were to see this kind of move, that would give me and probably a lot of the crypto crowd some hope that you may actually have some late end of year kind of movement going to the upside for Bitcoin. But I need to see this pattern break. This pattern has been pretty devastating for the bears. Every time a little bit of a rally gets going, this trend line here seems to knock it back down on its back, right? So we want to see some change in behavior here for Bitcoin. If we do see that kind of move, then I may look for a small long position. And if I take that trade, I'll share it inside of our Discord and talk about it in our Telegram channel, which I mentioned are linked in the description down below. While Bitcoin has not followed its seasonal pattern, NASDAQ and S&P 500 have mostly done pretty well in line with their seasonal expectations, essentially a upward drift expected during this time of year. Just take a look at S&P 500, for example, and it looks really nicely in line. Another really interesting market to watch here and keep on your radar is the Russell 2000 index. It's sitting at an all-time high, actually getting there sooner than both the NASDAQ and S&P 500. I'm watching for a breakout on this chart and do think that this thing has some potential to make a bit of a run up and maybe, just maybe, hit my year-end target that I made last year around this time. Candidly, I thought there was more upside to come in the Russell this year, but still we've had a pretty solid year for Russell. And just goes to show I do these kind of end of year, next year targets for mostly just for fun. I'm a trend follower. I don't make huge predictions about where I think markets are going to go and ride or die on those ideas. I'm adaptive. I follow what's happening in markets, as I mentioned earlier and have ranted about in every single video for the last 5 years. I'm a trend follower. I follow the macro, I follow the price, and if something changes, I humbly submit to the market. You are correct. I was wrong. And I follow trends. It has been, it's a game-changing thing, but it's amazing how one of the first things we as traders learn is to follow the trend. The trend is your friend. And yet most people mess that up. They completely fight trends. When gold is moving up, they're upset and trying to short it and trying to call the top, etc. So, what I found is it's much easier to go with the trend than to try and fight it. Speaking of trends, I'm still long gold, trailing stops on this one. And again, just following the bigger picture here. I think the Fed's going to cut interest rates, and I think that the dollar has more short-term downside to come. So I'm looking for a breakthrough this level here. If we can get that kind of move, then I will continue to trail stops. But for now, stops have just remained snug below this consolidation zone that we've been sitting in the last 1 week. If we break to the downside, I'll take profits. And if we make a move higher, then I'll look to trail stops further. I do still think that gold is likely wanting to go back and retest those all-time highs if the trend continues to play out. We've seen a constructive higher low overall in this market, and I am looking for that next higher low to sort of tighten my stop up a bit more and lock in more profit.